You've all heard the old saying, don't put all your eggs in one basket. Well, that's what it means. It means taking a look at the broad global investment marketplace, deciding on which assets fit your risk profile, your risk tolerance, and your personal preferences, but will also help you meet your goals. And using the avenues available to you, you would then go and put together a portfolio of investments that will help you meet your goals. Now, what is diversification? It means that you're simply looking at many different investments that are not correlated, that are not connected, all right? So you wouldn't want to go and invest in Coke and Pepsi and think that you're diversified. You're really not. They're the same company at some level. You're going to have some differences, but they're both soft drink companies. They own a number of businesses, snacks and drinks and different food options. So that's what we have to understand in the way of diversification. So what we want to do is diversify across asset classes, across industries, and even across countries, so that when something goes wrong in the soft drink business, it doesn't affect oil and gas. And something goes wrong in oil and gas, it doesn't affect the technology business. And all of those assets are working toward your goals as far as being a part of your portfolio, increasing in value. And when one does well, maybe one isn't. And if one, the other, it goes the other way. And when everything is clicking on all cylinders and they both are advancing, that's when your portfolio is clicking on all cylinders, and you know you have a globally diversified, well-positioned and structured portfolio. So that's what we're talking about when we discuss risk and return. And you have to understand from a mathematical perspective, which I can get into with you, but it's really irrelevant at some level. The math has been proven that when you own more than one stock, or you've diversified your portfolio, that the actual overall level of risk in your portfolio goes down, even if the returns are similar, right? So that's what we have to understand, that diversification helps decrease your overall investment risk, all things being equal. Now, we've talked about a lot of things, and one of the things I want you to understand is there is a balance. And that's what we're talking about as far as having a professional help you understand your risk tolerance and assess your risk. Having a professional help you assess the risk of an investment or fund or stock. And then figuring out from there how to construct a globally diversified portfolio that is going to help you reach your returns, goals, and objectives. So what are we talking about from that perspective? Well, I want you to understand that in order to reach your goals and objectives, you have to balance the risk and return trade-off, right? You have to understand that you can't go for full safety or you're not going to meet your goals, and you can't go giddy up on your returns, or you won't be able to sleep at night thinking about what your investments are going to do and whether or not they're going to be there to help you meet your goals overall. So there's a balance, right? And it's very important to align your investment choices with your risk tolerance and your financial goals. I can't say it enough. It is very important to do that. So think about it this way. I'll give you an example. Let's say high, medium, and low risk. What is a high risk investor? Well, just take someone who's 25 or 30 years old. They don't have any plans of using their retirement money at any time in the future, at any near point in the future. They'd like to have their portfolio remain as aggressive as possible. Well, let's say they are 100% stocks. That would be a very aggressive portfolio. And let's say someone's in the middle of the road, right? They're 45, they got a family, but they're not retiring anytime soon. They love their work, but they want to make sure they're on a steady pace to get where they're going. All right, we take a portfolio and adjust it and maybe put 20% fixed income bonds in that portfolio, just so that some of the volatility that you see in the portfolio is dampened by some of the lower risk assets, okay? So you'd have a 80-20, 80-20, 70-30 portfolio, which will still gain and approach levels that stock returns can get you without all of the volatility. And then take a low risk investor. Well, take someone who's right at retirement or just retired, and they are very nervous about how they are going to manage this asset, as well as make sure they have income for themselves to go forward in retirement. Without an income, you want to structure or help them structure a portfolio that's going to be safe, that's going to meet their needs, okay, in a very constructive, deliberate, safe way. All right, so hopefully that gives you an example of different styles or different portfolios that you might construct based on your risk tolerance. All right, so if you are a part of the course, there will be a quiz that you can take and a questionnaire that will help you understand your risk tolerance. All right, and in the next class, we're going to discuss the results and how they relate to your investment choices. All right. Also, I want you to, if you're part of the class, we're going to do a diversification simulator. All right. What we're going to do is conduct a simulation where you, students, our class, will build a hypothetical investment portfolio. All right. We're going to take a diverse mix of assets, and we're going to discuss how diversification impacts risk. All right. And then we'll take a look at some case studies and look at individuals who have made investment decisions based on their risk tolerance and look at the outcomes of their decisions. All right. Anything else you have, please leave in the comments or in our discussion. We're going to be in our discussion board. We're going to be recommending books, articles, and other online tools that will help you delve deeper into the concepts of risk and diversification. All right. So get going on this stuff, guys. I like discussing this. It's fun to me, and no question is off limits. I think if you have a question, most people will probably have a very similar question. All right. So I'm going to also put a homework assignment together for you, and I want you to research and present the members of the class a brief report on a historical financial crisis or market downturn. And I want you to highlight the role of risk in the event and how diversification or the lack thereof may have affected investors. Some different times in the last 20 years, 30 years that we've had events. I want to take a look at it. All right, guys. So by the end of this lesson, by the end of lesson 3, after all the case studies and assignments and things, I want our students to know and understand the risk and return trade-off. All right, the risk and return trade-off in investing, and be able to assess your own risk tolerance and appreciate the role of diversification in managing investment risk. This knowledge is crucial for making informed investment decisions, and it sets the stage for exploring specific investment options in later lessons. All right, guys, thank you for joining us. Thank you for being a part of the course, and I wish you well in your investment endeavors. And if you want to contact me, I would suggest you get in touch with me. I want to engage with you, and I want to help you understand investing, guys. We all should be better at thinking about our futures and preparing for our future legacy and our future generations. And investing is one of the best ways you can start to do that. All right.